Good morning, everybody, and welcome to the webinar part of the third PPL Employer Roadshow. Thank you for making the time to be here, and thank you also for the trustees for joining us today. A quick bit of housekeeping. We are recording the session, the open session, but only the presenters can be seen. You have the opportunity to ask questions anonymously as we go along, either in the open session or the closed session. And if you indicate which session you would like the questions to be answered in, we will follow that. If not, we will make a judgment in terms of where the question would be best answers. Looking at the speakers, we have a number of updates for you today which are positive, and hopefully they will allow you to see how we have been progressing. I'll be facilitating the session as the chair, but we will be hearing directly from both PPEL and the trustee. From PPEL, we have Graham Jones, who is PPL's actuarial consultant, and Alistair Charles, who is a director of PPL and also an actuary. From the trustees, we have John Bridger, who is the trustee chair, and Stephen Graham, who is the chief executive of Plumbing Pensions. Looking at the agenda, these are the topics that we'll be covering. The format will be familiar to those of you who've attended previously. We have an open session with the trustees, followed by a closed session with the employers only. One small change to the format is we'll be presenting the journey plan and valuation together as a joint session. And this allows the issues to be looked at from both sides of the governance table at the same time. So hopefully it'll be more coherent and more useful to you. Turning to the employer update, the PPL board, we've been fortunate to be relatively stable over the last few years. We've had one change during the year, which is the APC appointed representative is now Andrew Beaumont, who has replaced John Thompson, who retired. Andrew is an ex-trustee and has significant experience around the trustees, and I'm sure you'll all join me in welcoming him on board. Looking at the projects the employer company has been working on, we can probably say that a large part has been carried out in preparation for this year's valuation. This is the first test on whether the journey plan and statement of investment principles we agreed previously are delivering the results we want. We've also looked at the governance system introduced 4 years ago, and our conclusion is that we've achieved what it was designed to do. I do hope that you agree with us on that. We are assessing the impact of the new funding regime, and you'll see more of that later in this presentation. One area which has become more prominent the closer we get to buyout is scheme exit by choice. This is not really a project we're working on, and the trustee will explain the mechanics later in this presentation. But from PPL's perspective, I just wanted to explain we cannot advise any individual employer on exit. What we can say is that in similar schemes, the cost of exit tends to fall the closer to buyout we get. This means that employers naturally start weighing the commercial reality of exiting against staying in the scheme and following the normal time horizon. This needs to be handled carefully, with advice and with trustee engagement, being mindful that it does have a cost attached to it. Looking at employer engagement, a final word on this, we are very pleased with the level of engagement that we've actually managed to achieve during the past 3 years. As you can see from the charts, we have engaged with 68% of employers who represent 82% of the Section 75 debt. As an organisation, we have to offer the opportunity for you to engage. We do this through newsletters, the roadshows, and this webinar. You have taken that opportunity, and it genuinely strengthens the governance of the scheme. So thank you again for taking the time to be here and for participating in the webinar. And I'll now pass you over to my colleagues from the trustees. Over to you, John.
So I think I'm going to pick up first, Dean. But thanks very much for having me and me along. Obviously, the first thing we want to touch on is the membership that underlies the scheme. This is why there is a pension scheme. This is why there are liabilities. Your staff, many who are on this call will have had staff who have participated in the scheme over a number of years. In fact, there has been several thousand employers that have participated in the scheme over the years. But the membership stats, which this slide shows, you can see are incrementally getting less and less year on year. This is expected because the scheme closed on the 30th of June 2019, and thus there are no new members coming in. You can see that the other thing that's happening is the proportion of the blue and the red is getting closer and closer. It's almost reaching the stage where they're equal. And that again is to be expected. The blue represents those members that have savings in the scheme but are not yet retired. And because there are no new members coming in, that proportion will only get less, and the red section, the retireds, will only get more as time goes on. The retirements that the scheme processes year on year is moving very quickly toward the peak level of retirement. So that is, in any given year, the maximum number that will retire, and that's going to be hit in 2028. Which is showing we're reaching kind of a key peak point in the scheme's history. Another reason, so there's a couple of reasons that we will expect this population to get less and less as time goes on. Roughly over the last 3 years, there's been a reduction of about 2% per annum. One is there's no nice way to say it, but is natural attrition of membership as they reach the end of their lifespan. But there is other work that this trustee has been doing in the background, which is to trace members to try and that we've lost contact with over the years, to try and discover what their current status is, and that has led to some reduction in member numbers. And the other thing that we've been doing is, where possible, paying out small lump sums for small benefits. So that removes those benefits from the scheme and the member from the scheme, and often the small lump sum is more valuable to the member than a very small annual pension. So there's various bits of work going on that is leading to feeding into the membership reduction numbers. Just to note that a good chunk of the red section, the pensioner section, is insured through a buy-in policy. That buy-in policy is an asset of the scheme, and insurer pays us a value equal to the amount that the scheme pays out to those members. And that, as time goes on, the number of members that fall within that is decreasing. So currently it's roughly about between 65 and 70% of the pensioner population is covered by that buy-in policy. I think that's probably enough to say on membership. We'll maybe just go to the next slide, which is on the employers themselves. At the start of, so this covers the period from April 25 through to April 26, a scheme year. We started the year with 317 employers. We finished the year with 314 employers. And the green to orange boxes in between explain what was happening with it between those two numbers. You'll see that there was 2 employers left the scheme voluntarily, which employers have a right to do. Under the regulations, they can issue a notice to the trustee to voluntarily trigger their Section 75 debt, and upon payment of that debt, they cease to be a statutory employer in the scheme. And just to note, we will come on to the scheme exit process, which is different because that an employer's to a dual obligation to the scheme, one through statute, through legislation, and one through the scheme rules and the obligation to the scheme rules. So I'm just speaking about the obligations that arise under statute at the present time. I suppose I just note, when employers leave voluntarily, it's not necessarily a bad thing for the scheme. If they trigger a Section 75 debt, they have to pay the Section 75 debt, which adds money into the assets of the scheme each time it happens, assuming, of course, that the employer has enough money to pay that Section 75 debt. These two employers, one did not have enough money to pay a Section 75 debt and thus fell under Condition I, and one did pay a Section 75 debt in full into the scheme. The purple box covers insolvencies. This is just natural with a scheme of this size and the number of employers. There inevitably we do have insolvencies. None of these insolvencies are caused by the scheme specifically. It's not to do with the obligations to the scheme. These insolvencies are just the natural course of their own trading. And in such circumstances, the scheme becomes an unsecured creditor and will submit a claim just like any other creditor. The blue section, the light blue, is an employer who left the scheme, so an unincorporated employer left the scheme as a result of a flexible apportion arrangement, and the orange box next to it includes that -1. There's a +1 directly corresponding because that unincorporated business incorporated and became a limited company and came into the scheme. There were also two other employers, as you can see, that were added in, and these are employers that had previously ceased to be statutory because of debts in the past. Instead of paying that, they have agreed with the trustee a flexible proportion arrangement and have come back in as statutory employers. And just to give you an idea, that group of three collectively bring to the employer covenant, or the collective balance sheets of all of the employers, it added about £4.6 million to the balance sheet. So we ended up then with 314 employers. So I suppose just to highlight that the number coming down does not necessarily equate to bad news for employers, because part of that number coming down can be additional assets coming into the scheme that corresponds to it, and more assets coming into the scheme ultimately can help speed the journey plan on. So just to cover the three main things that the trustee is working on. Firstly is an employer, a member portal. You'll know there is an employer login section on the scheme's website. There's been nothing to date for members. The trustee has been working on a member portal, which is currently being tested. The reason employers should be interested in this is the member portal is going to allow members to do quite a bit more directly themselves, including updating their addresses, running retirement projections, seeing their transfer values, and all of that equates to less pressure on the administration team itself. So we should be able to run the administration side of the scheme more efficiently as a result of the member portal getting bedded in. The other important thing we've been doing, and very big thing we've been doing, is work on data and the documentation that underpins the data. And the reason you should, again, be very interested in this is that insurers and end game providers will look very closely at data to to see what it's like. That there's good documentation in place, good benefit specifications in place. The data is good audit trails in place, and all of that will help get the scheme more commercial, better, more competitive pricing. So this is very important as we look forward to the future, and the scheme is well progressed in the work on the data. And there's another major project we're working on, GMP equalization, which is technical and is again well underway, but it's just something we have to do by law. It doesn't change benefits terribly much, but is a major piece of work that we have to complete. I'll not say anything more in GMP equalization, and I will hand over to John to give a scheme funding update.
Thank you, Stephen. Good morning, everyone. I'm
Sorry,
John Bridger.
Sorry, John. Sorry, could we just go back to the previous employer slide? We've actually received a question on that.
Okay.
Stephen, the question is, what effect does a smaller employer population have on remaining employers in the scheme?
So, to what I suppose, in terms of the covenant that a lot of the smaller employers bring. So when we say covenant, I'm just meaning the collective financial strength of all of the employers combined to be able to stand behind the promises in the scheme to members. Those small employers do not add a significant value to that covenant overall. So a small employer leaving the scheme for any reason doesn't really shift the dial in terms of the covenant that sits behind the scheme. For the remaining ones, there's really no difference with them being in or being out to some extent. Obviously, if you add them all together collectively, there is some value there. But we do believe that if they were ever called upon, that those smaller employers oftentimes couldn't really afford to contribute to the scheme additionally with additional contributions. I don't know what else the question maybe has in mind.
I think really it's more to do with if the employer population gets smaller as a total. So we've gone from 317 to 314. What impact that has on the remaining employers. I think from your explanation, what you were saying was that depends on the reasons why.
Absolutely.
So employer population is reducing.
So if they all did what the green box says and voluntarily triggered a Section 75 to embed in the full value of that Section 75, that essentially would just accelerate the journey to buyout. It wouldn't be detrimental to the remaining employers necessarily. If they all went insolvent, on the other hand, it would put a greater burden on the remaining employers. So it depends the reason, but it's definitely not a bad thing necessarily that the number's coming down.
That's great. Thanks very much for going back on that, Stephen. That's appreciated.
No problem.
Sorry to cut across you, John. Over to you now, back onto your approach. Just thought we'd answer that as we went along.
No, that's fine. Thanks, Dean. Yes, I was just introducing myself. I'm John Bridger, the chair of the trustee board. And just to echo what Stephen was saying, many thanks to Dean and Alistair and the rest of the PPEL board for inviting the trustee to your roadshow seminars and today's webinar. So I'm going to cover, my updates is going to cover the funding position of the scheme and also investment strategy as well. As you can see, there's lots of numbers and jargon on these charts. And so I was going to start with a brief recap as to how we go about assessing the funding position of the scheme. But actually, just before we get into the detail, the key takeaway message in terms of scheme funding is the scheme is in very good shape at the moment from terms of its financial position. So, I get into the detail, I get into the numbers, I get into the jargon, but that's the sort of key takeaway message in terms of funding. So, you know, hang on to that over the next few minutes. Right, into the detail and in terms of, I guess, how we measure the scheme's funding position. And there's essentially two different measures used for different purposes. Something called technical provisions, and then also solvency. So again, we need to be clear whether we're talking about technical provisions or we're talking about solvency. Let me just describe each of those. So technical provisions assumes that the scheme is ongoing, and it's about estimating whether the scheme has enough money to pay benefits to all members as and when these benefits fall due, as and when members retire and draw their pension. So this measure determines whether any deficit contributions are required from employers. And that assessment is carried out every 3 years by undertaking an actuarial valuation. And the scheme's next actuarial valuation is due with an effective date of 5th of April 2026. So just over a month ago. And so work has started on this exercise. And as Dean said, we're going to come back to the valuation later on this morning. So that's technical provisions. It's all about our deficit contributions required. It's about the valuation of the scheme every 3 years. The second key measure of the scheme's financial position is the solvency funding level. And this assumes that the scheme winds up and members' benefits are secured by purchasing annuities with an insurance company. And this is the ultimate funding target for the scheme, and getting to this position would enable all employers to exit the scheme. And the solvency funding level is also used to determine Section 75 debts, which Stephen was talking about earlier. So again, we're going to talk about the scheme's ultimate funding target and the journey plan to get to this target later on this morning. So we're going to come back to the solvency target and later on. But in the meantime, the graphs on this slide are just focused on that first measure of funding, technical provisions. And I guess it's really about, does the scheme need additional contributions from employers to ensure that it has enough money to pay members' benefits in full? And at the moment, the answer to that question is no, the scheme does not need additional contributions from employers. The scheme is very well funded in terms of technical provisions. So this year's actuarial valuation is going to do all of the detailed number crunching to check, to confirm that position. But what we do between actuarial valuations is to track the funding level, albeit on an estimated basis. And the two graphs on this slide these are graphs that the trustees look at on a regular basis, and we share with PPEL as we go through the period from one valuation to the next. And what these graphs are showing is that the funding position, again, the technical provisions funding position, since the last valuation has been very stable. And that's either in terms of the funding level, which is the graph on the left-hand side, which has been around 100% during that period since the last valuation, or in monetary terms, which is the right-hand graph, which shows there's just been relatively small changes in the deficit since the last valuation. And actually, there have been periods when there's been a very small surplus in the scheme. And then we've got another very similar graph, again showing the sort of information in a slightly different way. And this is, in this graph, we've shown the assets of the scheme in red and how we think they've moved over the last 3 years compared to the scheme's liabilities shown in blue. And yet again, you can see from this graph that those lines track each other extremely closely, which is why, you know, the funding level has been very stable, and the amount of deficit or small surplus has not moved particularly significantly during that period. This stability that we're seeing in these graphs and we've experienced over the last 3 years isn't an accident. The scheme's investment strategy has been deliberately structured, deliberately designed to try and make sure that the scheme's assets move in line with changes in the scheme's liabilities.
John, can I just one question? Obviously, normally when people see a graph falling from left to right, it is seen as a bad thing. Obviously, here it's not the case, is it?
No, that's the other sort of key point to sort of take away from this graph, is giving an indication of the overall size of the scheme, both in terms of scheme assets and scheme liabilities. And Plumbing Pensions is a large pension scheme, as we all know. And at a current date, looking at the right-hand side of that graph, around £900 million of either assets or liabilities. And what's happened over the period since the last valuation, which is typical actually for a lot of UK pension schemes, that it has both the assets and the liabilities have reduced over that period, primarily due to an increase in UK interest rates, which actually reduces the value of the scheme's liabilities. And as we've structured the assets to track the liabilities, the value of the assets has come down as well. So yeah, in terms of your question, Dean, the fact that we've seen that reduction in the overall size of the scheme is not particularly a concern. You know, the assets and liabilities attract each other closely. That's been the most important thing.
Thanks, John.
So we touched on a sort of feature of the investment strategy when talking about funding, that structuring the investment strategy to move in line with changes in the scheme liabilities. So there's two other things that I wanted to highlight today in terms of investments. The first one is that since or after we did the last valuation, discussions with PPEL in terms of, you know, what the scheme's future investment strategy should look like. PPEL in turn then consulted with employers, and that was one of the main topics for last year's roadshow, which was all about, if you were at the roadshow or on last year's webinar, as you'd expect, the balance between risk and return in the scheme's investment strategy. The outcome of those discussions, that consultation, was that the scheme has adopted a slightly higher return target than it did previously. And that does involve taking a bit more investment risk. But the trustee was comfortable with the level of risk, that it wasn't excessive. I think at the time, and we'll touch on this later, is I think Dean and PPL, when they were consulting with you guys, talked about the sort of medium risk approach. And the actual return target we landed on was gilts plus 1.5%. It's the, again, some more jargon. Pension schemes tend to look at returns relative to the return on government bonds, and so gilts is essentially the government bond return, and so we're trying to achieve a return of 1.5% over and above the return on government bonds. So that's now in place, and I guess what that means is that all other things being equal, the scheme should reach its ultimate goal of full funding on a solvency basis a little bit earlier than it would have done previously. Yes, there's a little bit more investment risk, but we're comfortable that that's still an acceptable level of risk. And then the other point to note, which is really the charts on this slide, which I'm not going to go through in detail, but it is to do with investment risk, is that since last year's roadshow, the trustee has delegated the day-to-day management of the scheme's investments to Willis Towers Watson. So the trustee still retains, in conjunction with PPEL, we set the target, the overall return target, the gilts plus 1.5% I just mentioned, the overall kind of risk parameters. But then in terms of, what investments, what type of assets we invest in, what investment managers, we delegate those essentially day-to-day decisions to professionals who are investment experts who are doing that all day, every day. One of the things that means is that it enables the scheme to have access to a much greater range of assets and a much wider pool of investment managers. And that in turn means that the scheme can adopt a much more diversified investment strategy. And that's really just the message we're trying to show in terms of the chart on the left, is that the current strategy, and there is a greater diversification there compared to 12 months ago. And again, diversification in an investment context is a good thing and does help to reduce investment risk.
John, that leads on to a question that's been raised. I think it's one that's been asked at every one of the roadshows we've done, because it's obviously on everybody's mind, and it's to do with the impact of the uncertainty in the US and Middle East, and how that will impact on scheme funding and investments.
Yep. Yeah, so the charts that we were looking at in terms of funding, as I said, they're the charts the trustees we look at our meetings and in between meetings, and we share with PPEL. I guess we've been putting this presentation together for a little while now, started back in March, and the last quarter end numbers were 31st December, which is why all of those charts referred to 31st December. Obviously, we've got the position at the end of the first quarter, and beyond that, up to a current date, which crucially includes the valuation date, 5th of April 2026. And the message is very similar. The stability that we've seen in those charts up to the end of December has continued through the first quarter of 2026 up to a current date. And so a lot of the chaos, shall we say, particularly when Trump has been doing what Trump does with some of his announcements and rhetoric, at the moment hasn't had a major impact on the scheme, and that stability, which is a sort of key message from those previous graphs, is still very much the that's unchanged.
Okay, thank you.
Okay, the last slide from me. And again, well, but Dean said, I said, we're going to come on to talk about the scheme's journey plan towards its ultimate target of being fully funded on a solvency basis, which, as I said earlier, will enable all employers to exit the scheme. But there's also, as you know, currently a lock-in rule, which is designed to protect the interests of all employers. Which is probably part of, gets to the question earlier that Stephen was answering in terms of the number of employers, that even if there is inevitably a little bit of natural wastage over time, we've seen that just with a small reduction in employers over the last 12 months. The intention certainly at the moment is trying to, maintain the employer strength collectively, both in terms of covenants and numbers. So there is a lock-in rule that is, we'll look at that and review that as part of the valuation process. But I guess the lock-in rule is essentially, it does allow employers to leave, but it's at the discretion of the trustees, and the trustees will consider that and will consider allowing an employer to exit, but only, and the crucial bit is only if the employer is willing to pay an additional amount over and above the individual's in Section 75 debt. And the rationale for that additional payment is to compensate for the loss of employer covenant by that employer leaving the scheme.
So the reality of that, John, is the fact that the whole idea is, obviously we're here to look at all employers. So the idea is on the scheme exit is to ensure that the scheme isn't left with a disbenefit from somebody leaving in terms of the covenant strength. So that's the whole purpose behind the exit, to ensure that everybody's treated equally.
Yeah, absolutely. Yeah.
Okay.
So I'll pick this bit up again and I'll power through this quite fast. So just to note and remind you that there is a login section on the scheme's website. So that's plumbingpensions.co.uk. There's a login area for employers. Some of the charts you've seen a little bit earlier, the funding update graph and the investment, where the investments are available on a quarterly basis to employers, so they can log it. You can log in and see these. You don't have to wait the roadshow event each year to find out where things are. There are no consultations immediately planned, but as always, if there are, the maximum number of employers responding gives the most representative views to PPL and to the trustee when they're making their decisions. Your opinion really does matter. We always ask, and we appreciate when employers fill out the scheme returns. We'll come on a little bit later to talk a bit more about why that's important as we look ahead, but we do need you to fill that in. It shouldn't take very long at all. 5 minutes, I think. If you have the information to hand, you should be able to fill it in and submit it electronically back to the trustee. And the last thing is more a thank you rather than an appeal, because the vast majority of you do this. It's the VAT invoices that we issue at the end of October each year, which represents roughly about £700,000 of money to the scheme, which when you pay back from HMRC, helps keep the running costs of the scheme as low as possible. If you did not reclaim the VAT and give it back to the trustee, then that 700,000 would be an additional cost on the scheme and ultimately an additional risk to the employers here. So to tell you that the last couple of years we've collected 98% of all of the VAT invoices that we issued. So I do appreciate that the vast majority are paying it, and thank you for that.
Okay, can I just stop there? We're just going back to the exit slide again. We've got a question: is can an employer find out the cost of their Section 75 debt without triggering it?
So the answer to that is yes. the trustee agreed some time ago to do updates for employers at no cost to an employer, as at every valuation point. So the last time would have been 2023, and an update will be done for the 2026 valuation. So it should be available hopefully early 2027.
That's great. Thank you. Moving on. Alistair, Graham.
So I think we start this section, and this section is dealing with the journey plan, which is the agreed journey that we on to the ultimate end game, shall we say. And we start with, first of all, with John, if you can just outline the trustee objectives, and then I'll explain what the employer objectives are and how they align and so forth.
Yeah, sure. And yeah, a lot of words on this slide, and this is from a trustee point of view. When we're thinking about an end game and employers exiting, there's a lot of, I suppose, trust law, pensions law, the trustee rules itself, the pension regulator. But the number one priority from a trustee perspective is the security of members' benefits. So whatever we do, any sort of transaction in the future, the key issue for the trustees is that the benefits for members are secure as a result of that transaction. So that's the key thing that we'll be looking at as we go through this process.
Okay, thanks, John. So we go on to the next slide. PPEL, we are here to represent employers collectively. And so all of your views, we do appreciate that individual employers are in different circumstances. And so we do take account of that. But in the main, we look to represent all of you collectively. And that's why your engagement is very helpful, very important. So if you have any thoughts, feedback, please do share. We welcome it. This explains or sets out our understanding of what employers' objectives are for this scheme. And I will start by saying that obviously employers have participated in this scheme, and the purpose of that was to provide pensions to employees. And so that does align with the trustee objectives in an objective to ensure that members' benefits are paid in full. Going beyond that, though, we appreciate that employers, it's very important to employers that they, shall we say, cease their obligations to this scheme as soon as is practically possible in a way that manages risk. And so it means not putting everything on red, not taking unnecessarily high risk, and therefore not triggering the possibility of employer contributions being required should a deficit emerge. And this deficit, one of the key measures for that, obviously, is technical provisions, which John explained earlier. So we do look at the technical provisions measure, which is quite important. And that being stable is key. Beyond that, though, what we're looking at is how can we get to a point where employers can exit the scheme, and the buyout liabilities or solvency liabilities is the key measure that we look at for that. So if I come on to the next slide, this brings that all together. And this is what we looked at the last valuation, the 2023 valuation, where we looked holistically at a number of factors to enable the trustees to invest targeting a higher return, which we've set at gilts plus 1.5%, as explained earlier. It is important that the covenant or the backing of the employer base, shall we say, is there and can be relied upon. And that's why the lock-in rule is considered as part of the valuation. And so we agreed as part of the 2023 valuation to extend the lock-in rule and keep it in place. That enabled the trustees to agree to a higher investment return. And we agreed that what we're targeting is to insure all of the liabilities as soon as reasonably possible with an insurer. At the time, we estimated that we'd get to that endpoint around 2036. And I'll come on next to talk about where we are on that journey. But just to explain, that is the target, the current plan. We're aiming to fully insure all the liabilities. At that point, all of the employers can exit the scheme and have no further obligations to the scheme. And this is all set with a medium risk sort of approach. We are looking at alternative solutions, which is to say, that is the current intention. If it is possible at all to get there sooner or in other ways, then we will consider those. And we'll talk about those a bit more later. So I think that's all I wanted to say on this slide. On the next slide, what we're saying here is we have a projection that I said we estimated will get there around 2036. It's not a straight line path that normally happens. So there are different pathways, which this slide is explaining, that may all lead to the same outcome. If we find ourselves above or below the pathway at any given point in time, that doesn't lead to us panicking. That's to be expected. If you looked at the charts before of the technical provisions, which we said were relatively stable over time, they weren't a straight line. They were actually going a bit like this, but they remain within a reasonable range. If we go far off the range, though, then we will look at the circumstances and consider whether we need to take any corrective action if we are far behind, or in fact, if we are well ahead, then maybe it opens up opportunities to sort of lock in the gains that we've made. But just because we're ahead of time at any given point in time doesn't mean it's guaranteed to remain so. So that's what I wanted to explain here. Having said that, we have some very good news stories, which I hope you'll agree, of the journey to date. This slide goes back before the last valuation. So at the last valuation, we did put this plan in place and a new investment strategy, and the trustees then went on to appoint a manager to deliver that investment strategy, minimizing risk along the way. And that sorts of starts from the April 2023 figure. If you look further behind, you can see that actually the scheme has been on an improving pathway in terms of the buyout level of liabilities over time. So the scheme has shrunk in size over time, but the deficit has been closing in and the buyout figure has been closing in, and that has continued to be the case. These buyout figures are used not just to get to the end point when employers can all exit, but also before the scheme actually closes fully. In the meantime, if an employer triggers a Section 75 debt, then this effectively is the measure that's used to determine that employer's Section 75 debt that they will have to pay. So this is the big number. It's shared across all employers. If you go back to 2016, it meant over $1 billion in liabilities across the then number of employers was their share of the Section 75 debt. So it would have been very significant at that time. It is a lot smaller now per employer on average. If we come on to the next slide, this is the good news story that I want to update you on. And as I said, it's not a straight line path, but the red line does show, if it was a straight line, this is the journey that we set out that gets there by 2036. And the blue line shows the progress to date. We've been broadly in line with the plan, and more recently, we've seen a very significant improvement in the position. So the buyout deficit has come down quite significantly from 258 million across all employers to 107 million. So we are, I would say the key takeaway here from this is we are certainly at the moment on track and in fact ahead of plan. It means it is possible that we can get there earlier. We are exploring what options we have, and that will take a bit of time, but we are exploring what options we have if we continue to target the buyout target, or whether there are any alternatives that we can look into. The reasons for this improvement, I'll ask Graham to come on and explain, and then go on to talk about other potential endgame solutions as well.
Thanks, Alistair, and good morning, everyone. Yeah, just to pick up on what Alistair has said there. So, yeah, we've seen a really big improvement, strong improvement in terms of where we are relative to our target buyout position. Couple of main drivers behind that big improvement. First one I'll touch on is insurer pricing. So ultimately we are targeting building up a level of assets that we could then pass to an insurer, and they would then take those assets and use those to pay members benefits for the rest of the time. But importantly, when those assets are passed to the insurer, employers can exit. We've seen insurer pricing improve quite significantly, so it's become less expensive over that just short of 2-year period from April 23 to December 25. Big driver for that is sort of new entrants coming into the pensions market, both new entrants from an insurer side, so that driving down prices, but also new entrants in terms of alternative solutions, which Alistair alluded to a few minutes ago, are alternative solutions that we are considering and we'll touch on in a second as potential alternative exit options for employers, but all of that have of those new entrants into the market have effectively led to insurers pricing a lot more keenly, which is of benefit to us. The other driver that has allowed us to reduce that deficit significantly is it's ultimately driven by the way that the assets are invested. We saw a few slides ago a slide that John spoke to, which showed the assets and liabilities moving about in generally in sort of unison. So when assets when liabilities have risen, assets have moved in the same direction. That is because we've set the assets up in a way such that the technical provisions position moves in a similar fashion on the asset and liability side. Because this is a slightly different measurement, we have actually made some gains relative to that buyout position, given the direction that financial markets have moved in, which again, has been a big positive for the scheme. I'll move on from here to just touch on that. So growing spectrum of what we call end game options. So that these are introducing some of the alternative end game solutions that we've been considering. So on the left hand side of this page, we first piece we have is full insurance. So that today is what we have been targeting as part of the journey plan. So Alistair mentioned reaching the target back at the valuation was reaching full insurance by 2036. So growing the assets to that level to be able to afford that over that period. That has long been seen as the gold standard in DB pensions for paying member benefits over the long term, due to the security of the insurance regime, giving confidence to the market that the insurers will be around for the long term, and allow them to pay members benefits, and importantly also allow employers to exit. We've seen some developments, and we touched on some of this last year. On the middle box here, we reference a super fund. So super funds have entered the market, and they ultimately look to get the scheme transferred to an insurer in the fullness of time. But they add a midpoint to that journey that would potentially allow employers to exit their commitments to the scheme slightly earlier. What the super fund does is, once a level of assets that has been built up that is less than what an insurer would require, the super fund would take those assets from the scheme, allow the employers to exit, and then run the scheme on for a number of years before passing to an insurer. What's in that for the super fund is that when they run the scheme on before it's passed to the insurer, they will look to build up some excess assets, and they will take those as profit. This is a careful decision-making process that would have to be gone through from both PPL side and from the trustees side to be comfortable that this is an appropriate way to take the scheme forward. From the trustee point of view, a lot of consideration to be given, because they're effectively giving up the employer covenant slightly earlier than they would otherwise, by letting employers exit earlier than they would under full insurance. What the trustees get in return is some additional capital that's provided by the super fund, which, I guess the investors in the super fund are then ultimately looking to make profit of as the scheme is run on. The super fund market, and there is one main super fund out there at the moment called Clara. They have done to date 5 transactions in the market, so it is becoming more embedded, more understood in the pensions market, and that is absolutely why it's something that is in consideration both from PPL and the trustees as a potential option for Endgame. We'll continue to monitor and consider whether that might be an appropriate direction of travel for the scheme. And then on the right-hand side, we have a box that titled Sponsor Transfer. So what this scenario would see would be the existing employers effectively being substituted out of the scheme for a new employer. So existing employers would leave the scheme. They would their current commitments would cease, and a new employer would come in and be responsible for the ongoing running of the scheme. We have recently seen the first transaction of this kind in the market just over the last 6 months, and it was between what was the Stagecoach pension scheme. So Stagecoach, the transport company, they were replaced as the scheme sponsor by Aberdeen investment managers. The reason that Aberdeen were interested in that deal and why it made sense for them was that scheme had a relatively high level of assets, which meant that moving forward, Aberdeen will run the scheme in a fashion that will allow them to access some of the surplus and effectively additional assets that are built up in that scheme. In turn, members actually will benefit from a slight top up to the benefits that they were promised. But importantly, there from an employer point of view, Stagecoach, who were the existing employers like you are now in the plumbing pension scheme, Stagecoach were able to exit the scheme. So again, because of that opportunity to exit, it's something that is very much in our consideration as we move forward. I'll pause there in case there's any questions come in or anybody wants to add anything to that.
John, Stephen, do you want to add anything?
Not from me, Dean. I think Alistair and Graham done a great job describing, I guess, the issues that the trustee and PPEL are getting our teeth into now and over the next few months.
I think probably the one thing to make clear is that I think, Graham, you alluded to it, but it's not a quick decision, whichever route we go down, is it?
Yeah, you're absolutely right, Dean. There is a lot of due diligence and careful thinking to be done to make sure that members' benefits are well protected, that the employers get the solution that works for them as well, and under each of these cases there is a lot of operational work that's required to give or to satisfy the ongoing provider to the scheme benefits that they have all of the information that they need to be able to confidently provide the correct benefits. So quite a long lead-in process, which is why it's important that we're considering all these options just now. But yeah, as you say, Dean, it's not a sort of overnight switch on any of these cases.
Great, thanks. Moving on.
Thanks, and I won't dwell too long on this slide. The crux of this is the pensions regulator is very aware of the growing number of options that are available to pension schemes, and they've set out some expectations in terms of how trustees and sponsors should work together to consider and potentially deliver on these. I think it's fair to say that we were probably slightly ahead of the game here in terms of the collaboration that's existed between PPEL and the trustees. Now, if looking back to the last valuation, the collaboration that was there to set up the journey plan was great and really important in terms of the gains that we've made over those 2-3 years. I think we are very mindful of what the pension regulator expectations, and I think we've taken a lot of comfort in the way that trustees and employers are working together. Very much sort of meets those expectations. So we wanted to share that with you and just give you the reassurance that the collaboration between trustees and PPL is very much in line and was ahead actually of what the pension regulator has published.
We've actually had a question come in. With the sponsor transfer member gets discretionary benefits, how do they differ from full benefits?
Yeah, a good question. So first and foremost, important to say that the members will absolutely get the benefits that they were promised, or that is very much the intention of the transfer case between Aberdeen and Stagecoach. That is the most important piece. I think the top up that would be available to member benefits, the specifics of that are I think are in the public domain. It would depend on the sort of level of additional assets that can be built up. Important that they are still that there's enough of a cushion there to absorb any negative movements in market conditions. So yeah, don't know the details in this particular case, and in future cases it would be very much a sort of negotiation between the parties involved, but very important that a cushion is maintained, and the additional assets aren't paid out to the members or, importantly, to the new sponsor, that could cause any challenges if market conditions were to turn against the scheme.
Okay.
So this is I will just add to that and say this is an example of a run-on strategy. So in the other two cases, full insurance and superfund, the members' entitled benefits as they are what are being secured. Nothing else is the intention, just the members' benefits as they are. And what is in it for any party? The superfund case, the superfund provider, Clara, expects to make some return, some money on the journey to get a buyout until it's eventually secured with an insurer. In the sponsor transfer case, it is a run-on strategy. So you all as employers, if this was done for a scheme like this, for example, this is the way to allow employers to exit, which would meet our objectives if this was possible for a scheme like this, replaced by another sponsor. And that sponsor expects something to be in it for them. This, in this case, is Aberdeen. And they set up a way here where the surplus in the scheme is basically shared between Aberdeen and the members. So there's something in it for Aberdeen, and there's something in it for members where they get benefits exceeding what they're actually entitled to.
Okay. Thank you, Alistair. John, anything you want to add?
Sorry, just getting myself off mute. But not really anything to add. I think when I talked about security members' benefits, again, the main focus for trustees is the guaranteed level of benefits that are in the rule, that are set out in the rules. That's what we're trying to protect, and that's what we'd be trying to secure in any transaction. And as Graham said, if there's a discussion to be had or even a negotiation potentially involving discretionary benefits, so over and above the guaranteed level of benefit, obviously from a trustee point of view, would be very happy to engage in that, but it would depend on, obviously, the circumstances and the other aspects of the deal, I guess.
Okay, we've actually had another question here in terms of, I suppose, alternatives. Is what is the position re the pension protection fund if the scheme moved to insurance company buyout, super fund, or sponsor transfer options? That's a good question.
It is, yeah, Joe. I'll take this one. Yes, so just to explain for anybody who's not aware of the pension protection fund. Pension protection fund exists under the current DB pension regulations, under that regime. It is there in a situation where if there was no sponsor support for a scheme anymore, and there is not sufficient assets within the scheme to be able to pay member benefits in full, the Pension Protection Fund will provide a sort of minimum level of benefits to members. So not the full level that they would get within the scheme, but a reduced level. Under an insurance company buyout, the scheme would move out of the pension regime, pension regulation regime, which includes the PPF, and into the insurance regulation regime, which is different, but is very rigorous. So that there are very strict requirements placed on insurers around the level of capital reserves that they need to hold in order to be able to absorb adverse movements in market conditions. So under the current position that the PPF provides, Pension Protection Fund provides a little bit of an underpin, but if moving into the insurance regime, those capital reserves in that regime provides an additional degree of confidence that you will and insurers will retain the necessary level of assets to be able to pay member benefits, and I refer to it as a gold standard before, so you can have a lot of confidence that member benefits will be paid. Under a super fund, for the I said that you move from the current scheme arrangement into a super fund for a period of time before then going on to the insurer regime. When you take that step into the super fund space, the Pension Protection Fund protection is still there if it was needed. What the super fund will provide, I mentioned, was some additional capital into the scheme, which is there to effectively help protect against those adverse market conditions and hopefully are intended to keep you above PPF level funding, but if it was required, the PPF would still support the scheme. And then on sponsor transfer, the regime is exactly the same as it is just now, that the PPF Pension Protection Fund would continue to exist and protect the scheme if funding fell.
Okay, thank you. Hopefully we've got that covered. Shall we move on? On to the valuation at 5th of April 2026.
I'll start with just to outline this slide. We've covered quite a bit already, so I won't dwell too much here. There is a valuation as at 5th of April 2026, which work has started on, and we expect to have a lot of deliberation and consideration between PPEL and the trustees, crunching all the numbers, and then come to employers with output, shall we say, and things to consider, which will be done in the February 2027 roadshows. So we'll talk about this a bit more, but we've moved the roadshow next year earlier so that we can talk through the valuation and the other things that we'll be considering as part of the valuation. So definitely strong encouragement for you all to please join us for that roadshow and share your thoughts. The valuation will consider a couple of things. The main thing is we will look at the technical provisions, which, as John said before, has been fairly stable, and the current estimate is that it remains fairly stable, but we will do the exact figures to determine whether any employer contributions are required, which is that gray box, which we hope is not necessary. Beyond that, as we did last time round, we will look beyond the technical provisions. In a way, the technical provisions are there, okay, to ensure that that isn't required, but then really that's not our focus. Our focus then is on the journey plan. And as part of the evaluation, we do look at the journey plan. Is the current journey plan fit for purpose still? What is the end game that we're aiming for? Is it the same thing? What is the estimate as to when we expect to get there? We'll have an update on that position. and other considerations like the alternative solutions, which ones could potentially be viable, the investment strategy that we currently have, does that remain fit for purpose, or is there any proposed change to it? And the lock-in rule, which is there to hold together as much as possible the covenant support for the scheme, which backs up the investment strategy we're taking. We will also look at that as part of the evaluation. There are, I mean, this scheme is well ahead, I think, so it's fair to say, of the regulations on valuations, because we've had a longer term plan in mind for years now. A lot of this thinking is now more cemented in the new funding code, which will apply to this valuation, but we've, in the main, been ahead of the game and been thinking along those lines anyway. This next valuation will have more technical things that we have to sign off. So there are official documents and so on that PPEL and the trustees will have to sign on, but that's rather technical. And in the main part, the gist of the evaluation would not change from our current thinking. So this is just getting onto the new funding code, which I'll pass on to Graham to talk a bit on.
Yeah, thanks, Alistair. And I wouldn't say too much on this. I think Alistair's given a good high-level summary. The pensions regulator has released this, what they've called the new funding code. It just sets out expectations of what should be agreed and documented between trustees and employers throughout the valuation process. Real key point behind this was the pension regulator looking for all schemes to have to take a long-term view, to put journey plans in place and think about the long-term future of the scheme. We've now had that in place for a number of years, which, as Alistair said, means that we are sort of ahead of this code, which is great. What it will mean is between the trustees and PPEL, there are a few smaller details that need to be agreed and then written down in a slightly different fashion to how they would have been at the previous valuation. But that will, the impact of that will be, yes, sort of felt by the trustees and PPEL and not so much by you as the employers. What we anticipate doing, much like 3 years ago at the previous valuation, is at the roadshow next year, coming to use the employers with a summary of the valuation position and some options and proposals around the ongoing strategy of the scheme in terms of how we reach the end of the journey plan, which we will take your views on, and we will use those to feed into what's required for the new funding code, but also for how the scheme is run from a funding and investment perspective moving forward. And that will all be done in collaboration with the trustees.
Next slide.
And I think I've probably covered everything I wanted to say on this slide as well. Just a little bit more detail really about the valuation process and the new funding code. But key point to reiterate there is that for you as employers, this code will not make the valuation process feel drastically different at all, and the details that need to be provided to the pensions regulator as part of the valuation submission will be arranged between the trustees and PPEL, and the input that you give us, much in the same way you did 3 years ago, will be used to inform that. Yeah, so last piece from me for just now. just a summary of where your input as employers is required and very much welcomed. Stephen, I think, mentioned earlier the biannual scheme returns, which your input there directly influences the assumptions that will be used for the valuation. The next one of those is out next month, so yeah, please do participate in that. And then in terms of your next input, looking ahead to the February 2027 roadshow, which, yeah, as we mentioned, we've plan is to bring that forward from the usual time of year to fit with the valuation timeline. Expect to be bringing update on the valuation position, an update on the journey plan, and some options around how we move forward from there to get your input on. That will feed in, your input will feed into the what's called the statement of strategy, which relates to that new funding code I mentioned, and then the bottom piece there, the recovery plan. We hope not to be speaking to you about any need for contributions. Yeah, as part of the next valuation, and as we've mentioned a number of times, the progress in the funding position has been positive. So yeah, we're not expecting to have that conversation with you.
Great, thanks. John, Stephen, anything you want to add?
Nothing from me, Dean.
Stephen?
No, I don't believe so.
No?
Yep.
So I think for me, obviously, just to re-emphasise the scheme returns, I think that they are important at the best of times, but during where we are now in terms of the valuation process, they are really quite important. So yeah, can we just emphasise that needs to be completed? And then the next slide. This is just a teaser for the February 2027 roadshow. This is very important because this is where we will be reporting back to you on the valuation and the journey plan and other options. So your participation is extremely important to us on this. And so, we'd ask that you, keep in mind and keep a lookout for what is coming through. Alistair, anything to add?
No, not for me, thanks.
No. Moving on for the final slide. So this is the Q&A. I think we've probably dealt with the Q&A as we go forward. So what I'd like to do is stop the recording at the end of this session. Say thank you very much to the trustees for attending. We are going to go into closed session now, which is just the employers. This will not be recorded. And this is where we'll go back through some of the slides and things like that. Some additional details, but just from the employer's perspective. So again, thanks to John, thanks to Stephen. Stephen, John, do you want to add anything?
Just thanks.
No, thanks
very
again,
much.
Dean.
Yeah.
We shall leave you to it.
That is great. Thank you very
Okay.
much.
Bye
Yes.
bye.
Final slide. I'd just like to say thank you very much for everybody for attending, to making time in their busy days to actually go through this. Please make an effort to come to the February event. It is probably one of the key and most important events that we're going to hold as we go forward, given the choices that we've got and where we are in terms of the journey plan. As there is a reminder there, we will be circulating a short feedback form for you. If you could fill that out, it would be extremely appreciated, because we use that to actually tailor the roadshow's contents for what you want to hear, and any direction you want to go on. And finally, can I just take the opportunity, these events wouldn't take place without the backroom staff. And I'd just like to take the opportunity to thank Sophia and Anna, who you haven't seen, who are the ones that have done all the hard work of organising and ensuring that this runs smoothly. So thank you very much for all your help and your input on this. And I think we can now bring this to a close. Thank you very much.